Delta, my favorite option Greek. It has at least 3 definitions, which we'll discuss in a minute, but we'll focus on its most useful definition for long-term investors and option sellers. It's a rough estimate of the probability your option contract will finish in the money at expiration. So how does it work? To understand delta, let's start with its basic definition. Build on that to understand why it's a decent measure of probability of finishing in the money. So what is delta? Here's the Investopedia definition. Delta is a risk metric that estimates the change in price of a derivative, such as an options contract, given a $1 change in its underlying security. So let's go through an example. Here's an example with Pfizer as of market close July 11th, 2023. Pfizer's currently trading at 36. Let's say you sold a covered call on Pfizer with an expiration of September 15th, that's 65 days away, and you picked a strike of 40, this one. Let's see what its delta is and see what it means for a $1 move in Pfizer stock. Looking it up on bar chart, we see it has a delta of about 0.13, and the price of the option is currently 0.21. So, capturing that information, let's see what it means if Pfizer moves up $1 or moves down $1. Again, Pfizer's price is 36. We're doing the September 15th 40 strike covered call. The option price is currently 21 and the delta is 0.13. So if Pfizer moves up from 36 to 37, the price of that option is going to be roughly 0.21 plus the delta, 0.13. We're going to move up to 34 cents. If Pfizer moves down from 36 to 35, then the price of that option will be 0.21 minus the delta, or approximately 8 cents. As the underlying stock moves in price, either toward or away from the strike, the delta will change. The measure of the rate of change in delta is another Greek called gamma, but that's beyond the scope of this video. Delta also tells option traders the hedging ratio to become delta neutral, but this is also beyond the scope of this video. So we'll conveniently ignore it. A third interpretation of an option's delta is the probability it will finish in the money at expiration. This is the most useful one for option sellers. I'm showing a Stack Overflow post here. It's linked in the description. It explains why delta can be used as a rough estimate of the probability of an option contract finishing in the money. From the linked post, one way to think about it is to look at the probabilities and deltas of in the money, out of the money, and at the money options. A deep in the money option has a really high chance of expiring in the money, around 100%, and it has about 100 delta. A far out of the money option has a really low chance of expiring in the money, around 0%, and it has about a 0 delta. An at the money option has about a 50-50 chance of being in the money, because there's a 50-50 chance of the stock going up or down, and it has a 50 delta. Let's take a closer look at the money options, because there's usually a small bias toward the underlying going up, and it shows up in the deltas. We're going to examine Bank of America's monthly options for the rest of the year for some anecdotal evidence to see this bias. But first, if you're enjoying this content and want to learn more about options for long-term investors, please like and subscribe. I'm not a financial advisor. This isn't financial advice. Please do your own research. Here's a spreadsheet showing the remaining monthly options for 2023 for Bank of America with their prices and their deltas. These are all at the money, the 29 strikes. BAC is 29.02 right now, as of close, July 11th, 2023. The prices go up, 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 up for puts and calls the further you go out in the future, as you might expect. Let's look at deltas. The call deltas are not 0.5 as you might expect. Instead, they're slightly above that, and they increase the further out in time you go. The put deltas are below 0.5 and they decrease the further out in time you go. Why is that? The market is saying Bank of America will probably be higher than $29 in the future. And it thinks it's more and more likely the further out you go. It's saying your calls have a 52% chance of getting called away at 29 on July 21st, and a 55% chance of getting called away in December. The puts agree with this assessment. They're telling you that there's only a 48% chance of it being below 29 on July 24th, and only a 44.5% chance of it being below 29 on December 15th. As you can see, calls are more expensive than puts. So there is clear bias. The option market thinks Bank of America will probably be going up over the remainder of the year, but we'll see. Sentiment is pretty good right now, so this is probably the case for just about every stock. In conclusion, you should be constantly monitoring your deltas. When you sell options, while you're holding options, when you're considering rolling or buying to close, always try to be aware of how likely it is that your option contracts will finish in the money. And delta is a really good estimate of this. Please consider liking and subscribing if you enjoyed this content.